Welcome to the June Q&A. Let's quickly get started. So the first question is, how do you view ROC or ROE while evaluating companies? In our long-term portfolio, we have some companies that have excellent ROC ROE and some companies with moderate ROC ROE. Peter Lynch in his book has not discussed much about ROC or ROE, and he's focused on earnings and improvement in earnings. While Buffett and Munger places great emphasis on ROC and ROE. Mr. Hiren Ved, if I remember correctly, mentioned that he missed investing in Bharti Airtel due to excessive focus on ROC. Okay, so first of all, let's understand that ROC or ROE is basically a ratio, right? Return on capital employed or return on equity. I'm not getting into the details of how they are calculated, but basically in ROC, you are taking into account both debt and equity that a company is used to fund. And in return on equity, you're just looking at the equity part of the capital structure. And when you're evaluating a company, right, typically an ROC or an ROE will give you a understanding or an overview of the quality of the company. A company with very high ROC typically tends to be a higher quality business, especially if the ROC or ROE are stable and consistent over a long period of time. If you think about businesses with moats, right, businesses with competitive advantage, you will realize that most of them have ROCs or ROEs which are significantly higher than companies which do not supposedly have any competitive advantage. So if you look at the Indian markets, and you do a screen for ROC greater than 25% and market cap of say 1,000 crores or more, there are only 42 companies that you will find today as on date. So it is true that in a way, if you focus on ROC, your playing field, right, the group of companies from which you can start looking at, your universe of stocks does get limited to a great extent. So that is true. Now, the way to think about any individual ratio or any individual metric is that investing is like a jigsaw puzzle, right? So you have these picture puzzles that kids used to do, or even today they do it. Each piece of the puzzle contains some information, but that is not the entire picture. So you need to take all the pieces of puzzle, put them together to get a clearer picture of what the whole is. Exactly same way while you are investing, individual data points will give you a part of the information. You then need to look at piecing them together to get a better picture. So you cannot decide on whether to invest in a company or not based on only one parameter, right? So ROC ROE will give you one aspect of analysis. You need to look at growth, you need to look at the longevity of the growth, how long that growth can sustain. You need to look at the quality of management, you need to look at the sustainability of the industry, you need to look at margins, how sustainable those margins are, and so on and so forth. So a lot of things have to come together to for an investment to become successful in the long term. Moving on to the next question. Next question is, it would be great if you could share your thoughts on investment opportunities in the Indian telecom sector for long-term investment. On one hand, the industry structure has become extremely consolidated with two strong players, one weak player, and now a possible new entrant. I'm assuming you're talking about Adani. The sector has very high entry barriers and thus competitive intensity may not increase in the future. It has also become a necessity. A small increase in tariff leads to significant improvement in EBITDA. However, it remains a capital intensive segment with poor ROC. Okay, so I think you've sort of answered the question yourself in a way. Uh, One is you're already seeing that it's a market with a small number of players, right? You basically have Bharti Airtel, you have Reliance Jio, you have Vodafone and BSNL, and a possible sideways entry by Adani through the 5G route. Now that's also not something that's very clear at this point in time. Now if I discount Adani's entry, even with the existing set of players, I think the challenges that the sector has is very very I mean, it is challenging, right? In the sense that competition is severe. It's very difficult to increase ARPUs. Customers are not willing to pay much more. So how many people are really willing to pay significantly more for 5G? I don't know. I don't personally think there are going to be too many people who are going to be willing to pay a lot more for 5G. Although the capex required for 5G is going to be significant. So again, these companies are getting into that debt cycle with very long payback periods. So to my mind, these are difficult businesses. As an external investor, or as a person, one way to think about it is, if I had a lot of money, is this a business that I would want to get into? To me, the clear answer is no. There are a lot of easier businesses to get into, where equal or more money can be made. So why get into something which is extremely complicated, extremely difficult, a lot of dependence on government policy? Overall, basically, it's a mess. Tomorrow Supreme Court will come up with some judgment on AGR dues and something or the other, and it's an ongoing mess. Let me put it that way. And I think Warren Buffett, as usual, has put it the most succinctly, in the best manner possible. I quote him when he says that, I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. And then that's a very, very important mental model to think about. Right? You don't want very complicated, very difficult businesses with so much interventions from different parts. A government can come and disturb your business. Courts can come in and disturb your business. Some new entrant can come in and disturb your business. Customers are unwilling to pay higher. Very, very difficult operating environment. So for me, this would be a definite pass. Moving on to the next question. Some guidance one should develop with respect to reading habits, investing books, annual reports, or content from people like you on social media. Okay, very interesting question. So first of all, I can give you some rules of thumb that I personally follow. Whether it works for you or not is something that you need to sort of determine, and you need to experiment with it over a period of time. So first of all, I think you need to read widely. When I say read widely, it's not about only reading investing books or business magazines, etc. But you need to look, read biographies, read history, psychology, literature, because ultimately investing is about understanding human beings, right? And all of these, how people behave in different circumstances, whether it is a business scenario, whether it is political, you will get inputs from the past, from reading history, from reading biographies, and over a period of time, you will find that you will be able to match different patterns. There is no shame in listening to audiobooks. Okay, I found that a lot of people think that I don't want to listen to audiobooks because it's not the same as reading. I don't think so. If books where especially fiction or biographies, or those kinds of books are very, very literature are very, very good if you listen to them. uh, Read every day. I think that is something which is very interesting, or rather very important. You need to take time out and read every day, even if it is 10 minutes or 15 minutes. Read one business newspaper. It could be Mint or Business Standard or Economic Times. Just one business newspaper is good enough. Uh, Even in the newspapers, try to focus more on interviews of business people, interviews, or where you can get data, right? Don't focus on stock tips, or don't focus on the more newsy part of it, right? This has happened, this tax has gone up, or this event has happened. The whole idea of reading a business newspaper is again to understand the context in the operating environment. So read it from that perspective, and that perspective, when you read interviews of business folks, that is sort of more first hand information. Reading opinion pieces is second hand information. So you are depending on somebody else's opinion on the facts, right? So you are one level away, whereas when you're reading interviews, or when you're listening to say con calls or whatever, you are getting sort of more closer to the source of the information. Similarly, you can read one business magazine that is out there. I think Business Today, Outlook Business, Forbes, Fortune, these four are pretty good. Even Capital Market, not Capital Market, what was that? Business India, sorry. Business India is quite good. So these out of these 4 or 5 magazines, you start with any one. Uh, Next is about a lot of people ask me about reading investment books. Now the thing is that once you read the top 10, 12 investment books in a particular genre, there is very little incremental learning to be had by reading the n+1th book. So the more important part is, instead of reading the n+1th book, you can, I mean, I do read a lot, even any new book which comes which I come across, I'll skim through. But what I nowadays do is, because I've read so many, I try to just quickly skim through and see that is there any new perspective that I'm getting from there. If not, it's just a very quick glance through, and okay, just reiteration of what I already know. So incrementally reading more and more books will not help you beyond once your concepts are there, then it is more about implementing, or then it is more about doing the actual grunt work of going through annual reports, con calls, even going through magazines, etc., where you are more in tune with what is happening in and around you in terms of business. Try and read at least one annual report every week or every 2 weeks, depending on how much time you have. And initially, I think, just if you are reading the director's report and the management discussion and analysis, that's more than enough. So just focus on the textual part, the narrative, and go through it. You'll and if you cluster a lot of annual reports of companies in the same industry together, then you'll start gaining a lot of knowledge about the particular industry, right? So that's also another tip and trick that I can share. On social media, I think it's very, very important to. So my baseline assumption on social media is, I assume that unless I know the person, I assume that most people who are just peddling gyan are either ignorant, or they have an agenda, or both, right? So my base assumption is that I should not follow anybody, right? Now after that, somebody tells follow this guy, or this person comes and gives good information on tweets or whatever, then I follow that person for a while and see if or I'll go to that person's timeline, go through what kind of content is being shared, and if it gels with me, then I will typically, I use Twitter. I don't follow anyone. I use lists for different people. So I put them in a particular list that I would want to then go through. But the whole idea is that don't most of the time it's better to stay away from so-called social media influencers, right? It's basically it's like any sport or anything, right? I mean, you would want to take advice, or you would want to take or watch say a Sachin Tendulkar bat, or a Roger Federer, or a Novak Djokovic, or a Rafael Nadal play, right? You would not want to pay and and watch me play tennis, or watch me play cricket, or whatever, or somebody else who is unknown or is not an accomplished player. So similarly, in social media, why would you want to listen to some random person giving random perspectives? It's like it's like a town square. Anybody can come and start screaming. Would you actually stop and listen to somebody who is screaming at the top of his voice in a town square, or in a traffic light? You would not, right? You would think that person is crazy and just drive by. Exactly the same here. Unless you know the person, or unless that person has some credibility, why would you want to listen to some random people talking about random things? So be very selective, because the problem with social media is that it's so ubiquitous that it's very easy to poison your minds, right? So be very, very careful to who you get information from, who you are following, because that will determine a lot in terms of how your thinking gets impacted. Okay, the next question is, apart from chemical industry, is there any other sector that will benefit from China Plus One? So very interesting. This is a tweet that I tweeted out. The newspaper cutting is from Financial Times. So Financial Times is, just as an aside, this is one of the best newspapers for getting a global perspectives that I personally found. I read Financial Times and Wall Street Journal on a pretty much regular basis, and also once in a while I'll read the Guardian or New York Times business section. But I find that the FT is by far the best, and even if I don't read the other newspapers, it doesn't bother me. But if I miss FT, it sort of has that nagging feeling that I've not done something for the day. So this particular piece was basically about HSBC as a bank setting up a CCP committee. Now CCP committee is basically is a Chinese Communist Party committee. Now the specific companies which need to set up those committees, and I'll read from here. A CCP committee is required by Chinese companies law, but has not yet been widely enforced among foreign finance groups. It is typically formed of 3 or more employees who are members of the Chinese Communist Party. Okay, a party representative is installed within your company's top ranks. So this is what is happening, and this is what the future holds for companies which are operating in China. Okay, HSBC is one of the most exposed global companies to the escalating geopolitical rivalry between China and the West. Okay, and the last part which is highlighted is saying that in May, HSBC's largest investor, Ping An, called for it to split into East and West units, warning that straddling both regions, that is the East of the world, which is China, Hong Kong and that part, and the West, would become impossible in the coming years. If you read, if you keep reading FT or all the other global magazines or newspapers, you will realize that a lot of large companies are, the Americans or the British or Germans, when the expat managers are leaving China, or when they're leaving Hong Kong, that position is not getting backfilled, right? So what is happening is a very slow and silent uh, migration away from China for some of these larger companies. Now, this is going to take a long time. It's going to take 10, 20, maybe 25 years. But this is something which is going to happen for sure. Yesterday, I was seeing a tweet from Rishi Sunak, from UK PM contender. He's tweeted out saying that China is the enemy number one. So this is going to be the predominant global political theme for the next decade or 2 decades. It's going to be Cold War Part 2. So in that kind of a scenario, it is obvious that global companies, Western companies, will start looking for alternate sourcing. It doesn't mean that all of it will go out tomorrow, all of it will come to India. What it means is that this migration is going to happen. How and when it will happen, how long it will take, is a matter of conjecture. And it is also not sure that India is going to be a winner. We need to get our act together in terms of labor laws, in terms of getting land acquisitions in place for factories to be built up. We need quicker, more business friendly approach. We need a consistent tax policy. We need quicker and better implementation of contract law. So all of those things are there, and that is how it is going to play out, in my opinion. So opportunity is huge in the manufacturing side, because China has been the predominant global leader in manufacturing. So next decade, if we get our act together, India is likely to benefit significantly. So that thing is something, I think, which is going to change the fortunes of a large number of companies over a period of time. Okay, I think this is the last question. Most of the time, what happens while long-term investing journey is that we want to become Arjun but end up becoming Abhimanyu. So question is how to overcome this situation. So Abhimanyu Chakravyuh mein phas gaya hai, Kishore Kumar song. So of course, I mean, selling is one of the most difficult decisions in investing, and there are a lot of mental biases, right? If you sell early and the stock goes up, you feel miserable. If you sell, if you don't sell and the stock falls, you again feel miserable, right? So it's a very difficult and dicey situation to be in. So there is no easy answer on how to sell, but there are a few strategies that one can use. You can sell based on valuations. So if you feel that a particular company has become extremely overvalued, you can sell that. What I personally follow is, I don't usually sell on valuations, because my experience is that valuations can remain overvalued for very, very long period of time, right? And just selling on valuation means that you may leave a lot of upside on the table. Second is, you can sell based on business performance. If you are expecting a particular company to perform well, and then you see that 1 quarter, 2 quarter, 3 quarters, it's not able to perform, and it's continuously giving excuses or making different excuses every time, then maybe it's time to sort of get out and move on. You can have technical stop losses, different types of technical stop losses, whether it's a particular percentage drawdown from the top. You can use chart patterns, you can use moving average, trend lines, you can have different indicators, right? So those kinds of technical exits are very useful. And lastly, you can create your own set of rules by looking at the index and individual stock prices. And again, this is more a technical approach, that you combine, if the index is falling, or if there's major problem with the individual stock chart, then you can get out. So these are individual ways which you can get out of a stock. There is no holy grail. You will still make mistakes, you will still have regrets. The whole idea is to keep continuously evolving your selling process based on how based on individualized rules that you follow, right? Don't just do something randomly. That's the whole, I think, key takeaway from this. With that, thank you for listening and spending time. Please keep sending me your questions, and we will meet again next month.